Inflation explained in 5 minutes. Inflation is an economic concept that describes the general increase in prices of goods and services in an economy over a period of time. It's like watching the prices at the grocery store slowly creep up over the years. But what causes inflation, and why does it matter? Let's break it down. What is inflation? Inflation is essentially the decrease in the purchasing power of money. In simpler terms, it means that with the same amount of money, you can buy fewer goods and services than before. So if last year you could buy a dozen apples for $5, this year you might only be able to buy 10 apples for the same $5. Types of inflation. Demand pull inflation. This type of inflation occurs when demand for goods and services exceeds their supply. When there's more demand than supply, businesses may raise prices to capitalize on the situation, leading to inflation. Think of it like a concert ticket selling out quickly, causing scalpers to charge higher prices. This can happen due to several reasons. When consumers have more disposable income, they tend to spend more on goods and services. This increased demand can outstrip the economy's capacity to produce, leading to upward pressure on prices. The government policies that increase aggregate demand, such as tax cuts or increased government spending, can also contribute to demand pull inflation. These policies inject more money into the economy, boosting consumer spending and driving up prices. Expansionary monetary policies, such as lowering interest rates or increasing the money supply, can stimulate borrowing and spending, further fueling demand pull inflation. Cost push inflation. Cost push inflation occurs when the cost of production rises, leading producers to increase prices to maintain their profit margins. This type of inflation can be caused by various factors, including increases in wages, either due to labor unions negotiating higher pay or minimum wage laws, can raise production costs for businesses. To cover these higher labor costs, businesses may raise prices, leading to cost push inflation. Increases in the prices of raw materials, energy, or other inputs used in production can also push up production costs, leading to inflation. For example, if the price of oil rises, transportation costs increase, which can lead to higher prices for goods and services. Disruptions in the supply chain, such as natural disasters, trade disputes, or geopolitical tensions, can lead to shortages of key inputs, driving up their prices and causing cost push inflation. Built-in inflation. Built-in inflation, also known as wage price inflation, where workers demand higher wages to keep up with rising prices, leading to further inflation. This type of inflation can be fueled by inflation expectations. When workers expect prices to rise in the future, they may negotiate higher wages to maintain their purchasing power. However, these higher wages can lead to higher production costs for businesses, which may then pass these costs onto consumers in the form of higher prices, perpetuating the cycle of inflation. Hyperinflation. This is an extreme form of inflation, where prices skyrocket uncontrollably. Hyperinflation typically occurs during times of economic instability, such as wars or political crises, and can result in the collapse of a country's currency. Hyperinflation erodes confidence in the currency, leading to a loss of purchasing power and undermining the economy's stability. As prices soar, people may resort to bartering or using alternative currencies to conduct transactions. Hyperinflation can lead to a redistribution of wealth, as those with assets like real estate or stocks may see their wealth evaporate, while those with debts denominated in the inflated currency may benefit. Hyperinflation can fuel social unrest and political instability as people struggle to afford basic necessities and governments struggle to maintain control. In extreme cases, hyperinflation can lead to the collapse of governments and institutions. Causes of inflation. One of the primary causes of inflation is when the supply of money in the economy grows faster than the supply of goods and services. This can happen due to factors like government printing more money or lowering interest rates, which encourages borrowing and spending. Another major cause is when the cost of producing goods and services goes up. Producers often pass these costs onto consumers in the form of higher prices, leading to inflation. Factors such as higher wages, increased energy costs, or supply chain disruptions can contribute to rising production costs. Apart from that, strong consumer demand can also drive inflation. When people have more money to spend and are willing to pay higher prices for goods and services, businesses may raise prices to capitalize on this demand, leading to inflation. Effects of inflation. As mentioned earlier, inflation erodes the purchasing power of money, meaning that consumers can buy fewer goods and services with the same amount of money. This can lead to a decrease in the standard of living for those on fixed incomes or with limited financial resources. Inflation can create uncertainty in the economy, making it difficult for businesses to plan for the future. When prices are constantly changing, it's hard for businesses to accurately forecast costs and revenues, which can lead to inefficiencies and economic instability. It can also lead to a redistribution of income and wealth within society. Those with assets like real estate or stocks may see their wealth increase as asset prices rise with inflation, while those on fixed incomes or with savings and cash may see their purchasing power diminish.